You're watching the Mortgage Busters show. My name's Greg.
I'm Adrian. There you go.
Adrian, what's going on?
Lots. We've had a huge response from last week with Steve.
Fantastic.
Regarding the developments, and lots of people want to know more and more things.
All about financial stuff, how to pay your mortgage off quickly and
how to
property development.
Turbocharge it, I think the word was.
Turbocharge, I love it. I love it.
So we got him on again.
Steve, welcome back to the show.
Thanks for having me. I appreciate it.
It's been great response from our audience.
Oh, look,
really good.
It's great. I think people are always looking for a way to really try and get rid of this mortgage, but not just get rid of the mortgage, do it quickly.
Yeah,
that's what we love.
Big difference. Big difference. 30 years.
So, can you help us out with more information about how to pay it off quickly?
Yes. Look, I thought what we'd start with today is just a simple structure. One of the things you asked me last week is how do we do it? How do we structure this mortgage to make sure we can get it paid off quickly? How about have a look at that now?
Yeah, fantastic.
Sure.
I love going to the whiteboard.
Oh, yes.
We love it too.
Excellent. So let's have a look at this. This is a simple structure we talk to our clients about all the time. Just the basics of how we should set this up. So let's say we've got a home over here. Don't you love my houses? A bit wonky there, but construction's okay. So this house is worth, let's say, $600,000. Standard mortgage on the house is $350,000. Now, as I said before, a bank will tell you to have a principal interest repayment. I said, look, no, don't do that. That's compound interest to the bank. That's in their favour, not in our favour.
It's totally against everybody's thinking, you know that.
I know, it's warped. I understand that, but bear with me.
Yep.
So what we're going to do now, attached to this home, we're going to put the facility the bank has that just they don't tell you about all the time. And this is just a bank account, but they call it a 100% offset bank account. The same can be achieved with another facility the bank has called a line of credit, but we're going to use an offset account for this explanation.
Yep.
So what we're going to do, we're going to put our wages directly into this bank account. So every pay packet, our wages are going to go in here. Okay, so this offset is just like any bank account you'd have. So you have phone banking, internet banking, all attached to this, ATM card, checkbook, whatever you want.
So everything you've got goes into that.
Absolutely.
No more separate
interest,
accounts.
all that sort of stuff.
Centrelink, whatever you can think of. It doesn't matter, whatever form of income, rental, put it in there. So it's very easy to track what you're doing.
So if they've got other accounts, one account.
Get rid of the accounts. I've said clients with 5, 6 accounts. Kiddie accounts, this account, that account. All you do, if you want to keep, say the husband and wife want to do things separately, fair enough. No excursions here.
Yeah, there's a few around.
We set up another offset.
Yep.
What a lot of people don't realise is most banks allow you to set up unlimited offsets.
Oh, wow.
I didn't know that.
There's another good secret. Oh, he's full of...
That's right. Look, if your bank says no, say, okay, I'm walking.
Yeah,
You
good.
set it up for me, I'm going. See you later.
Yep.
So you set up another offset. So here could be Mr. over here, Mrs. over here, however you want to do it. You could have the kids down here.
And
So instead of putting the kids in a little CBA kid account where they're making 3% interest, but then there's not much else going on, you put in an offset. Because what an offset means is that, let's say in your accounts, all these accounts added up, today you have, let's say, $6,000 in there. What it means is when the bank goes to calculate how much they're going to charge you in profit, which is interest, they go $350 over here in loan, minus the amount of monies you've got saved over here is 6. So we're only going to charge you interest on the difference of $344. So you're paying less interest back to the bank. Do you see how that works?
Like that.
Does that make a
Minimise
big deal?
Profit. It's a terminology, isn't it? It's just terminology.
But does it make a big deal?
We'll have a look how big a deal that makes.
All right.
So this is just simple at the moment, the structuring. So no principal interest. So what we're going to do once a month out of your offset, because that's where your money's going, you're going to have a direct debit to pay the interest on your loan. The interest. That's what you're going to pay. So not the principal initially, okay, interest. Then what you're going to do, once the interest is paid across there, obviously you're not reducing the $350, are you?
Yep.
Okay, now this house, let's say it's your first house. Do you think this is a house you're going to live in forever? Or do you think maybe you might upgrade in the next couple of years? What do you think?
Well, downgrade.
But most people tend to upgrade. They start with the basic and move up over time. So what happens is if people are paying this loan down over time, let's say in the next 7 or 8 years they want to upgrade, their mortgage might be down to $290 or $270 or whatever it's going to be.
Yep.
So when you move out of that house, that loan you've got left is tax deductible because then it's going to be an investment property. So if you've paid this house off over time and you move out, you've got no tax deduction left at all because you paid it off.
Yeah. Yeah.
And then you might as well sell the house. You're not getting tax deduction. So what people do is you pay interest only over here. So when you move out, you still owe $350. So you're getting a tax deduction on the full $350 when it becomes an investment. But what happens? All that money you would have paid in principal is growing in your offset account. So the balance over here every month is growing and growing. So all the money that you're saving, instead of paying off your home loan, this offset balance in 2 years might be, $40,000. So all of a sudden, you've built up a huge amount of money here.
And it stays in your offset.
Yes.
Okay, so it doesn't transfer to over here.
No,
Okay.
it doesn't.
Yeah,
so you're using this money in the offset
Yeah.
to put towards an investment for the future.
Yeah, yeah.
So you're not
Like a
paying off your
savings
home loan
plan.
here.
Another savings.
It's like a savings plan. Exactly right. And what you do then, instead of paying your bills every day out of your offset, what a lot of people do is they attach a credit card.
Yep.
Now these credit cards are generally 45 days or 55 days interest free. So they put all the expenses on the credit card, leaving their wages in their account longer. Because we know the banks are calculating interest every day. So the longer you can leave your wages in your offset, the more money you save.
Of course.
And so this is automatically linked to your offset. So whatever you spend on your credit card is paid out by your offset each month.
Fantastic.
It's a pretty simple structure, but
It's
banks
great.
don't tell you how to do this.
No.
And just by this simple structure, we can take our home loan from a 30-year home loan down to about 24 years. So a few simple changes. That could be saving you $100,000.
So just quick,
depending on the situation.
You've got 1 minute.
if your
1
loan's $1,500 a month with principal and interest, and you do interest only, that difference is what you're going to be saving.
Correct.
Is that what you're saying? And that's just going to keep going over there. Instead of going to them, it's going to you. Is that what I'm saying?
That's what we're saying. We're turning it around from compound interest in the bank's
So an extra
favour,
$300
compound
is going,
interest in our favour.
Yeah.
And all the savings you make in the offset are not taxed. They're tax-free savings.
Fantastic.
Oh, as well.
Really good work.
So
Okay, well, we need to go for a break, Steve. You're watching the Mortgage Buster Show. We'll be back really soon. You're watching the Mortgage Busters Show. We're with Stephen McClatchy from Loans Australia. Steve, property development.
Yes, we're sort of we're getting really liking this terminology because we know it. As I said before, it's what we call our number one debt weapon. It's a way that we can really pound down our mortgage as fast as we can. We can crunch it. We can do whatever we want to it. But what we're going to talk about now is some of the benefits, the general benefits of property development. It's okay to
yeah,
talk
yeah,
about?
absolutely.
Of course.
Okay.
Back to the whiteboard.
Okay, back to the whiteboard. We're going to talk about the 5 benefits of property development. Look, the number one benefit, the first one is what we call adding value. If we can't add value to something, we're not going to make profit. That's what it's all about. So the first one is we're going to take a piece of land, we're going to add value to it, we're going to make some money. So that's the number one benefit of property development. Number 2, people like new. Australians are famous for buying anything that comes onto the market. We love it brand spanking new.
Of course.
Yeah. And that's nothing the same with property. People like buying new property, they like living in new property, they like renting new property. You don't want to rent old property, you want a new property. So as a property developer, you are supplying a new stock to people. So automatically there's a demand for people who like things that are new. The third benefit, you're buying what we call wholesale. So what I mean by that is if you just go down and buy a property off the plan or buy it on the market through realestate.com, that's a retail price. You're paying the market price of it. It's full of everything. That's right. But if you are a property developer, you can save on stamp duty and also you're saving on the developer's margin. You now become the developer and you are making that profit. So instead of maybe buying that property at $500,000, you might be able to buy it for $450,000. Wouldn't that be fantastic?
Fantastic.
Yeah, make money yourself straight away. 4, profit. And that's what it's all about. It's about leveraging time and money. And most people don't know how to do that. They work their whole lives. They're doing the best they can. Lots of things are going on. They got kids, mortgages to pay.
Busy.
That's right. There's nothing left over. So that's what property development's about. It's about leveraging time and money, but using experts to do it. It's okay to make a little bit less money if you're going to make a profit. You don't want to risk it. Most people got stories about, I invested in this, I invested in that. There's an ant farm over here, investment, ostriches, they were great. All these fads that come out, you've heard about them all on television.
Tea tree.
Oh, tea
Trees,
trees, you name it. People have come out with it.
Yeah.
But if you stick to something that's been around forever, like property, you can't go too far wrong. And the last one, it's got tax benefits. As we know, new properties have what we call depreciation. And the newer the property, the bigger the depreciation, and your accountants will work out how much it is for you. So there's 5 basic benefits of property development.
And we can do all this for
You
them.
could do all this.
Yep,
It's possible.
They don't have to stress out. We can actually
No. I'm
take
even
them by
going to,
hand,
I'll give
step
you
by step.
a couple of examples of clients that we're working with and have been for a long time.
Yep.
And so what they've been doing to make it, some real life
Yep.
situations. We've got some clients at the moment we've been working for about 7 years. Just mum and dad living in Melbourne. And they had 2 properties at that stage. And they were working hard on their incomes. And the fact is that they had this passion for property. Might be their Italian heritage, I don't know, but
Yep.
they loved property and they wanted to start building. So the first thing they did was just a simple little subdivision, and they built a house on the back of their existing property. Not too difficult, and
Yep.
they found that went okay. We got them the money to fund it, and they ended up keeping that to start with. So what happened is that market in Melbourne started to move. So all of a sudden they're building up this equity in this property. So what they then decided to do is that they wanted to get a little bit bigger, and they got a thirst for it. So they ended up selling that property and using the equity from the property to go again. But next time they built 3 townhouses. And so what happened, they didn't go in all boots and all first time because they weren't sure of the process. And they fumbled their way through and they made some money, but they tried to do it all themselves. But as they went along, they worked out, they started finding a town planner who understood the regulations better. They found the proper draftsman. So they were starting to put what we call their team together.
which is already there.
It's already there now.
Already there,
So we're talking now, we skipped down 7 years,
Yeah.
and now they've got 4 development sites in the northern part of Melbourne. The development sites are all up worth about $12 million.
Wow.
So they've gone from
Yeah, that's a
2
great
basic
story.
properties
Yeah.
worth under $1 million.
Yeah.
Now they've got development sites worth $12 million 7 years later.
Not bad, huh?
Not bad.
In 7 years. There's that
7 years.
7-year thing again.
7 years is a critical factor. And look, we've got another client at the moment. It's a builder. This guy's been building a long time now. He's made profit as he's gone along, but nothing big. He's still got a mortgage on his own home, but he's very good at building, doesn't understand wealth creation or finance. So we came in and we showed him a couple of ways we could turn around with finance to go from building 1 or 2 houses, as he did for clients, to now he's just started a 12-unit site in Melbourne.
Fantastic.
Yep. And he didn't use any of his own money. We can talk about that later, how we did that.
That is great.
Well, that's another thing, isn't it?
Yeah, how do you fund these sites, which we'll talk about? Because
Yeah.
as we, some examples, you got $2 million worth of lending. How do we do that? And we will talk about that later on to make it all work for the mums and dads. Yeah.
So, Adrian, how do people get involved?
They call us.
Yeah,
They call us. They send us an email and we have a chat over the phone. Maybe they can send us some information. Email us some information. 1300 TMB.
We've got to go to another break, so we'll be back shortly.
Okay.
The last segment. You're watching the Mortgage Busters show. We'll be back soon. You're back with the Mortgage Busters show. We have the Mortgage Busters development arm, and I'm going to ask you, how do we make money in property development?
Fantastic, Greg. I'm glad you asked. What I want to do is go over this scenario so we can clearly see what the components are, what it's going to cost us, and how we make some profit. So this is what we call a finance feasibility. And we can do a quick calculation every time we are analysing a particular project. We do this up front. The first thing, we've got to determine what we're going to pay. So whether it's your own property, we look at what the value is, or whether we have to go and buy one, we look at what it's going to cost us. In this case, $750,000. Then we look at the acquisition costs of what it's going to cost us to get over the line. Now, if you already own the block of land, which a lot of our clients do because they want to do a joint venture with us, that's fine. We don't have to pay acquisition costs. But if it is a new purchase, we're going to have stamp duties and legal fees and things like that, which is about $42,000 in this case. Pre-construction. So these are plans and permits using a draftsperson or architect to put it all together to make sure that what we're going to build is actually going to get approved, which is critical. And that's going to cost us money, obviously.
Yep.
That's all got to be funded, which is about $38,000 in this case. That obviously differs depending on what we're going to build. And then it's going to cost us money to build, $1 million. Again, we don't just take one quote, we get a multitude of quotes. That's all about our due diligence to make sure we're getting the right people to build what we're going to build. There's no point getting someone who normally builds, a little two subdivision to do an 8-unit block. We want to get the right builders on board. So we add up all these costs of the project. It's going to cost us $1.83 million, which is a lot of money. I know it's a lot of money for people, but we're also going to sell it for a profit. So again, part of our due diligence was to check out with local agents, and a few ways of doing it. You can just go on realestate.com as one to find out what the sort of property you are selling is costing at the moment in that sort of area. This figure here is 2.5 million net of GST, government's piece of the pie. We have to allow selling agents. They're going to sell our properties for us.
Yep.
And we do a lot of that marketing up front. When we first start the development, 50,000, and then we've got to hold the property. So it's going to cost us interest. When we go to the banks, and we'll talk about how we get funding in a minute, how we do that, but it's going to cost a lot of money. Because every time we're borrowing money, we've got to pay for this. So I know a lot of people have said, how do we pay for that as well?
Right.
We'll get to that. So we add up these costs, take it away from what we're going to sell it for, and really we're going to realise 2.3 million in money. But we've had costs. We've had costs of $1.83 million. So then we get our profit of $470,000, which is a lot of money.
Yep.
It's actual national fact, it's a return of 25.7%,
Yep.
which is phenomenal. Like if we put our money in the bank, what do we earn in the bank at the moment?
That's a great return.
Yeah.
I
If you
know,
buy a
1%.
normal investment property, you're looking at normally a negative return to start with. So that's a fantastic return.
So this is really good for people that are got like 7-10 years to go for retirement. Can't do much in 7 to 10 years.
No.
You can't sort of wait for a property to increase in value, and especially if you've got 5 or 6 years to go.
Well, I think, a lot of people who are getting towards retirement or at retirement, their issue is that they don't have the income generally at that stage to pay off an investment property over the next 15, 20, 30 years. As we know, most mortgages go for a long period of time. They can't do it. It's unrealistic to buy an investment property towards retirement. It's not going to happen.
Plus their house might be old, it's falling apart, there's no money there either.
That's right. And when
there's
we
a
see
lot
that, it's a common sort of situation where a lot of people are not living on a lot of income. Somehow they want to get some income coming in. They don't want to move. They don't want to go to a retirement village or leave where they've been living for the last 20 or 30 years. They want to make something of what they've got. They want to leverage what they've got at the moment to make it happen. And what we say, a lot of people say, I can't afford $150,000 in interest. I'm barely getting by now. I haven't got much extra. Makes sense to me how they do it.
Absolutely.
Yeah. So why don't we talk a bit about how we fund
Funding,
this?
Yeah.
sure.
How we
of
make
course.
it happen. Okay. So in terms of how we fund these property investments, is the interest is the big killer. People can't afford to pay the repayments. So there's a terminology that banks use. It's called interest capitalisation. And what this basically means is instead of making every month the interest payment back to the lender is actually adding that interest on top of the loan.
Well, that's pretty handy, isn't it?
It's fantastic. It is.
So it can facilitate the whole development.
Yes.
Yeah.
So you actually don't have to make any repayments throughout the whole development. So when the lenders are working out how much you can borrow, they factor in that interest, that $150,000 into your total borrowings. So it's already factored in. So every month you owe interest, they just use a bit of the money they've already allocated for it. And they actually put a surplus in. They call it a contingency as well. So they make sure if there's overruns or delays in the projects, and they factor this into the whole feasibility of it all. That way the average person who are worried about how can I fund this, it's not an issue now because the banks have basically funded the whole development for you. How about that? The bank's helping you to make money.
Yeah,
it's amazing. So get rid of the P&I mortgage and property development can help you get there, especially for the people, as you mentioned, who are towards retirement, who've got an asset, they've paid it off or nearly paid it off. They could be sitting on something where they can make a lot of money.
That's right. They'll get something brand new at least.
That's right. So they could go from an old house which needs a lot of maintenance and upkeep or maybe not in the best condition to maybe building 3 or 4 townhouses, living in one, maintenance free for nothing, it's cost them nothing, and then having some profit on the other ones or selling them off or whatever they
Or
end up
just
wanting to do.
take profit and do something else, go away.
Yes.
Holidays forever.
Why not? Yeah, you're exactly right. You can do this. And in terms of, people have asked me, what bank's going to lend, a 65-year-old or a 60-year-old money? Now, the thing is, with this sort of funding, it's not the person, it's the project.
Yeah, that's important.
Yes.
Yeah.
So they fund based on the project, which is a fantastic.
That makes sense.
I call it pro-doc finance.
Yeah.
You're lending on the project itself, the profitability of the project, and there's ways of funding it. The main way that a lot of people use is banks. Banks, as we know, are pretty conservative in how they do, and you've got to tick a lot of boxes and dot a lot of I's. But if you can meet the bank's guidelines, you're going to find the interest rates are going to be the lowest, which is, and the fees are the lowest, which is good, as banks do, but they're very conservative. So they don't lend as much money. Then you've got other lenders out there, like second-tier type lenders, who generally lend more money and are more flexible in their terms and conditions. And you've even got other forms of financing, which we call mezzanine finance for some people. A lot of builders use that sort of thing to give them a bit more money, a bit more leverage, so they can continue to build.
I've heard that term quite a bit, in property development. What can you just explain that mezzanine?
Sure.
finance?
Or mezzanine funding is investors, private investors, lending money to help you leverage more. So you put less of your own money in, and you're using other people's money.
With more interest, of course.
Yes, of course. You pay them more money, but that's why you do a feasibility, is you can factor in up front the cost of this money. Now, the thing is, if you've got also friends and family who are coming in with you and using either their equity or their borrowing or their house, whatever they're going to do as part of a joint venture, that way, if you make a small bit of money, but you're not putting much in, everyone wins. So it's about leveraging your time and your money and using other people's expertise and experience.
Which we've got now.
Absolutely. And that's what it's all about.
Yep.
Fantastic. So how do we get involved? How do
So it's
the
the
viewers
Mortgage
get
Busters Development Arm,
development?
which Stephen is in charge of. He's our financial director.
And
So
that's right. It's all about following the 8 steps to property development, doing your feasibilities up front so we know exactly what the project's going to cost us, what we're going to build, where we're going to build, organising joint ventures with clients so that they can utilise what they have, but utilise and leverage our expertise.
even if your mum and dad, they're sitting on a block of land, everything's falling apart, but they don't want to mortgage it. They don't want to do this reverse mortgage thing.
Reverse
Yes,
mortgage,
yes.
Because that's another little
Done
catch.
lots of those reverse mortgage. Once you're in a reverse
Nobody ends
mortgage,
up
it's
with
hard to get
nothing.
out of it. Yeah.
At least this way, kids will end up with something because there
Yes.
will be a new property in return instead of
That's
just
great.
an old
You mentioned
property.
that. It actually brings, what I found, it brings
most of
families
them-
together.
Yeah. Most of them don't want to do that because they're worried that their inheritance is going to be
Yeah.
gone.
But it's about, as I said before, one of the benefits of property development is adding value.
Yeah.
So the parents are adding value to their land, and you can actually get the kids involved because they can see their inheritance is going to grow. So it's not actually a bad thing now. They're actually
Absolutely.
working together, and the parents, I've found, feel fantastic because instead of they're just sitting in their house for 30 years, what they're doing now is adding value.
Well, they don't have money to fix it. It's falling apart around them.
And, well, that's why we've had clients take reverse mortgages in the
Yeah.
past because there were not a lot of options.
No.
So they've taken reverse mortgage, they're paying a higher interest rate than normal. What they don't understand is the mortgage is compounding interest to the bank.
Just
so it's
explain
compounding
a little
and
bit more.
compounding.
Right.
Give them a bit more info on this reverse thing because
Well, the reverse
it's
mortgage.
scary stuff.
Well, it
We've got
is.
about 30 seconds left.
Okay.
so-
Well, it works like property development. So when we said you don't pay interest on your property development loan, it capitalises.
Yep,
With
yep.
the mortgage, is the same.
So it just adds on.
And
it adds on.
Yep,
It capitalising the interest on top of the mortgage.
So you've got nothing
don't
left.
get a reverse mortgage which helps the banks. Do property
We're
development.
running
I
out
say.
of time, boys.
Thank you very much.
Steve,
Thank you very
thanks
much.
again for a fantastic hour with yourself.
That's
Yep.
great.
Thank
Adrian,
you,
just
thank
a
you.
final one, how to get people
Yeah,
involved?
give us a call on 1300 TMB show or go to the website.
Fantastic. You've been watching the Mortgage Busters show on behalf of Stephen, myself, and Adrian. We'll see you next week.